Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey. Hello everyone, today I'm going to introduce a high probability trading system. In the market, a high probability trading system is what traders are eager to pursue. Today, we will focus on how to use the MACD and KDJ indicators to achieve a 90% or higher win rate trading strategy. This trading system combines the strengths of both indicators. As we all know, the MACD is a trend following indicator. However, it tends to lag. In a choppy market, it often gives contradictory signals. The KDJ, on the other hand, is a momentum indicator. But in this situation, it frequently signals long and then quickly signals short, causing false signals. So how can we leverage both to form a winning strategy? A high probability trading system. Stay with me. The results are coming up next. First, on the daily chart, we use the MACD indicator to identify the current market trend, such a trend of it. For example, when it signals a golden cross here, we consider the stock in a bullish trend on the daily chart. Conversely, when a death cross appears in the evening, it indicates that the stock is entering a downtrend correction on the daily chart. Downward trend. We keep shorting all the way down. No counter-trend longs. Only short the rebounds, short the bounces. Stick to this strategy until the trend reverses. Otherwise, we maintain this approach. Now, at this point, some might ask, what if a reversal happens and the stock rebounds from a low? Wouldn't that cause a false signal? Yes, if you mechanically follow this strategy, you might get caught in a rebound misstep. That's a risk during trend reversals. However, here you can filter out these signals by refining the strategy to avoid false signals. For instance, when it breaks down and retests, you can keep shorting. But once it reverses and moves above the 10-day MA, stop shorting at this time. Got it? This is optimization, building out potential reversals. This is one of the key points to watch out for. Alright, so how do we execute the trade? Use this stock as a practical example. Take a look at this stock. It dropped from $488 all the way down to $220. A steady decline on the daily chart. Then it's crossed all the way down. In this phase, we focus on shorting the rebounds. No longs, just shorting bounces. Okay, at the same time, once we confirm the downtrend on the daily chart, we switch to the 2-hour chart. Now let's go through the trading mechanism. Let's take a look. When the downtrend began, a death cross appeared on the daily chart. We focus on short positions. When it rebounded, we stayed out. We don't do this long trade, only focus on shorting the rebounds. Now, when it formed another death cross, we shorted again. It bounced again. We chose not to trade. Then when it crossed down again, we shorted. Shorted until it formed a golden cross at the bottom. That is where we took profit and exited. Shorted here, exited here. Then it rebounded again. We shorted here. Rode the downtrend until it formed another golden cross. The golden cross occurred around these two bullish candles. This area was our profit zone. That's a space where we captured the shorting gains. See that? You're in a rebound. Do we go long? No, we don't counter the trend until a death cross appears here, signaling a downward move. The pullback continues until a golden cross emerges at a low point. Then we exit. Hold the position until this point and then exit. See, this is the profit and range we captured from the short position. So we wait for the rebounds and avoid longs. Stick with shorts aligned with the downtrend. Opportunities to short come once, twice, 3 times, 4 times. So, in one market move, you can capture 4 to 5 trading opportunities. Watch opportunities. Focus mainly on the first major short positions and upward swing. The major swing is essentially captured, plus you avoid giving back profits during rebounds. If you short at this level, the rebound from the low might shake you out. But with our trading strategy, we can reduce our position and exit here. Then we re-enter with a new short position here. This is our ultra short-term, high probability trading setup. We enter a short position here, then we exit the position at this point. After that, we re-enter another short position here. Hold it until the low. When a bullish crossover appears here, we exit the short position when a bullish crossover appears again. So we effectively captured 1, 2, 3, 4, 5 short opportunities, 5 short selling opportunities. And the cumulative profit is greater than just holding from here all the way down to this level, right? That's our high probability short-term trading strategy with a 90% success rate. It's a complete trading system. This is a trading strategy I've been using constantly for over a decade. Now, some of you might be wondering if we can capture these short-term moves, can we also capitalize on medium-term swings? Yes, it's the same logic. Got it? So how do we do it? Simply adjust the time frame. By shifting the time horizon, we can adapt the strategy. It's not just for short-term trades. It works for intraday trades, daily trades, weekly trades, midterm trades, and even long-term trades. Let me give you another example. Many people ask, I want to catch a move like this one. I want to catch this wave. Can I do it? I want to catch this rally. Is it possible? Let's stick with the previous example. All right, let's look at the weekly chart. Let's check the weekly keyline chart. Can we catch this kind of opportunity? Let's see. Whether you are shorting from here or going long from this point, we can still capture it. Now let's focus on this area. This is a weekly keyline chart. Now look at the MACD indicator. From this point, it formed a golden cross, and it maintained until this point, forming a death cross. We confirmed the weekly trend direction. On the daily chart, we use the KDJ indicator to trade 2 swings within the daily time frame. When the MACD on the weekly chart shows a golden cross, we focus on going long. All right, let's continue. Let's take a look. So on the daily chart, how do we identify the trading opportunities? For example, at this point, when the KDJ indicator forms a golden cross here, we can choose to enter, hold the position until it forms a death cross. We exit. We perfectly capture this entire swing from entry to exit, right? Now, do we trade the pullback on the daily chart? No, we don't. We only take long positions in line with the weekly MACD trend. All right, now let's look at it again. Here we see another golden cross. We enter at this point. When do we exit? When it forms a death cross at this point, we exit here. Didn't we catch that move? Yes, but the profit wasn't substantial. Now at this point, I decide to enter again. Where do we exit? Right here, we choose to exit. This range is the daily swing we captured. Now this previous move was relatively small. So can we capture another daily swing? Yes, the same strategy. Look, a new opportunity appears here. We enter, right? Enter, then what? The price rallies. Where does it peak? It peaks here as a bearish crossover forms. All right, we choose to exit. Exit right here. After the bearish crossover here, we get another bullish crossover at this level. The bullish crossover drives the price upward, right? Then where does the next bearish crossover occur? It appears here after several days. We choose to exit here. So from this swing to that swing, the entire price movement is our profit zone. Now, do we see it clearly? We could have captured this wave by entering here, existing here, re-entering, and existing again. That's 2 swings captured. Adding them together, the combined profit is similar to just holding through the entire wave. But this approach is more flexible and responsive, right? That's our trading strategy. All right, many people might say, all these examples are from the past. Can we apply this strategy to current price action or even forecast future movements? Because only by replicating it can we accurately predict and analyze future market trends. That's how we can constantly make money in the market, right? Okay, let's take a look. Now we will use the current price action of this stock to predict how it might move in the near future. We do that. Look here. On the daily chart, we see an MACD bullish crossover. Now, how do we assess this point? It's a bullish setup on the daily chart. After confirming the bullish trend, we switch to the 2-hour chart to spot specific entry points. How do we do that? Let's take a look. On the 2-hour chart, the first bullish crossover appears. Where is it? Roughly around this area. We can enter during these 2 or 3 candlesticks and hold. Hold until when? Until a bearish crossover. Where does the bearish crossover occur? Here. Right here. Okay, so this range defines our trading window and profit zone. Now, after the bearish crossover, should we continue trading? No, why not? As I mentioned earlier, we avoid counter-trend trades to minimize risk. Now, look at this point. Although we see a bearish crossover, the market is still in consolidation. Pay attention here. Indicators are adjusting, but the price is consolidating at a high level. So there are not many profitable shorting opportunities here. To maintain a high probability trading system, we filter out these counter-trend setups. Things like these with limited range and potential are executed, right? What we focus on is aligning with the broader trend. We look for confluence between the 2-hour chart and the daily time frame. Then we follow the daily trend. Our trading system is a trend following strategy. Corrections and pullbacks are complex and hard to grasp. But once a bullish trend forms, it tends to continue upward. Same applies to bearish trends. So we only trade the impulsive waves, not the corrective waves. Corrective waves offer limited profit potential. They are also more complex and harder to manage. If you make a wrong move, you could miss out on the next big bullish opportunity. When you get trapped in a losing trade, not only do you lose money, but you also miss the next potential setup. So under these conditions, we only trade waves 1, 3, and 5, the main impulsive waves. We focus on trend, not counter-trend trades, counter-trend setups. Alright, at this level, we have captured the opportunity on the 2-hour chart. Now, when the second golden cross appears, where is it? Here, we decide to follow the trend. It's here or here. We choose to enter. Then it keeps rising, right? Making new highs, right? And then we hold until it forms a death cross. That way we can perfectly capture the main impulse wave following the big players, the smart money, the trend. We only target the most profitable part of the main wave instead of chasing counter-trend shorts. Got it? After entering at this level, we secured substantial profits. Then after re-entering at this level, we're not entering during a big rally. Look, this level shows a golden cross. See that? That's a golden cross. After the golden cross, we enter here and hold the position. This is far better than chasing the rally now, right? So by using this strategy, you can effectively manage short-term trades, holding positions for around 3 to 4 days. That's the strategy. But if you're trading options, this level of rally could easily give you a chance to double your returns. So that's what I'm sharing with you today, how to leverage the MACD and KDA indicators with a 90% win rate. So this trading system is a combination of the MACD and KDJ indicators. They work together to complement each other's weaknesses. Alright, that's all for today. Thanks for watching. See you in the next video.